Good afternoon, ladies and gentlemen, and welcome back to the Peterson Institute for International Economics. Those of you with us on the internet, hello. Those of you with us in the room, hello, and feel free to keep eating and get dessert, not for you on the internet. It is a personal and professional pleasure today to welcome Jose Vinals, financial counselor and director at the Monetary and Capital Markets Department at the IMF. We've been very fortunate over the last year and a half to work closely with the Public Affairs Department at the IMF and a number of the IMF leadership. And we've had some very intensive and I think very worthwhile discussions. First Deputy Managing Director David Lipton coming and presenting the outstanding work that the fund did on energy subsidies around the world. Cheng-Yong Rhee giving his first presentation of the Asian overview from when he took over the Asian department. A succession of fiscal department and European department directors without wanting to put too fine a point on it. Most recently are many of our friends, Vidor Gaspar, a very topical talk about fiscal policy, particularly as Europe tries to shift gears. But it is, of course, a singular pleasure to have Jose. One should never take Jose Vinals for granted, although the macro community in the world has been able to for about 20 or 30 years. After a distinguished career at the Central Bank of Spain, ending up as deputy governor after holding a succession of positions, he has been at the IMF as financial counselor, and as I said, director of the Monetary and Capital Markets Department. He has been there throughout the crisis and has been forthright, reasonable, calm, but on important issues, I think rightly immovable, which is kind of what you want from a financial counselor. And obviously, the global regulatory efforts that we're seeing now, he is playing a critical role as the IMF representative at the Financial Stability Board. Jose, of course, also is a distinguished academic, having taught previously at Stanford with his PhD from Harvard. But like so many of his colleagues at the director level at the fund, he chose to try to help the world instead of help his publication count, and for that I am grateful. So on that, I will turn to Jose to address for us what are some of the most current issues facing the world from the perspective of financial stability. Jose.
Thank you very much, Adam, and good afternoon to all of you. And what I'm going to do today is, first of all, try to make sure that I do not complicate excessively your digestion. And second, basically highlight some of the key messages that emerge from the Global Financial Stability Report that we published on the occasion of the annual meetings only a few weeks ago. And the story is a very simple one, and that is that nowadays, more than 6 years after the beginning of this global financial crisis, the world economic recovery continues to rely very strongly on monetary accommodation. But at the same time that we have an insufficient support coming from other policies, like structural policies that increase supply and other growth-friendly fiscal policies consistent with fiscal prudence that could also help on demand. And as a result of this incompleteness of the policy support and also of the very heavy legacies from the crisis, what we have nowadays is a very modest, or as we have said, mediocre economic recovery. And as you can see there, it's modest, and as time has gone by, we have progressively downgraded our economic forecast. So we have a modest, a mediocre, uneven, and fragile recovery, which is subject to important downside risks. But another consequence of this incomplete policy support that we are having, where monetary policy is doing too much of the heavy lifting, is the emergence of a new global imbalance. And this is what I want to focus on this presentation. A global imbalance at the, or an imbalance at the global level between, on the one hand, too little economic risk-taking in the form of investment and job creation, which is what you need for growth, and too much financial risk-taking in a number of aspects, which is something that may compromise over time global financial stability. So there is this imbalance. And although you need some sort of financial risk-taking in order to prompt economic risk-taking, we have an imbalance. Too little of what we really want to achieve, which is economic risk-taking, but some financial excesses in terms of risk-taking. And then I'm going to ask two questions regarding banks and shadow banks, or non-banks, if you prefer that name. On banks, the key question I'm going to ask is, are banks strong enough now to support economic recovery through lending? And that's something which is very critical in some parts of the world, and particularly in Europe. And regarding the non-banks or the shadow banks, the question I would ask is, are risks moving there? What type of risks? And in particular, I would highlight the risks having to do with the illusion of market liquidity. And I will conclude with some comments on how do you have to rebalance policies and what's the role of financial policies in basically addressing this new global imbalance that I'm going to talk about. So let me move into economic and financial risk-taking. And here you have a visual impression of this imbalance or disconnect at the global level. And if you look at the behavior of real investment at the global level and the behavior of market capitalization, you can see this disconnect, this imbalance between too little economic risk-taking in the form of real investment and a lot of financial risk-taking, which has been reflected in more money going into markets and higher asset valuation. So that's a global imbalance. But what form does it take in different regions? I think it's important there. And there, what you can see in terms of economic risk-taking first is that economic risk-taking is progressing at different speeds. It's overall not sufficient, what we would require for higher growth, but in some places it's doing better than others. And it's doing better in the case of the United States and until recently of Japan. And I'm looking here at capital expenditure and at credit growth to the corporate sector. And what one can see is that in the United States, things are looking better. In Japan, they were looking better. Now they're stalling a little bit. But where things are certainly not looking better, but worse, is in the euro area. And this is unfortunate. Capital expenditure, now it's at best stabilizing, but has been coming down, trending downwards. The same thing as credit growth to the corporate sector. And the same one can see in the key emerging market economies. So overall, economic risk-taking still limited at the global level and uneven in different parts of the world. How about financial risk-taking? Where are the excesses? And the excesses are mainly in fixed income markets. And I'm going to show these excesses with the help of a heat map, which basically look at 4 dimensions. And the colors give you an idea how over time these excesses have moved. And for example, when I talk about advanced economy sovereign bonds or advanced economies corporate bonds, is because there is where we see some of the excesses. Excesses in terms of valuation, overvaluation of prices, underpricing of risk. And what one can see is that in sovereign bonds in advanced economies, there is some indication of underpricing of sovereign risk. If we look at corporate bonds in advanced economies, there is also some indication of underpricing of credit risk. There is a significant synchronization between advanced economies and emerging market bond prices at high frequencies. And global volatility, which although now has rebounded, compared to a few weeks ago, still is compressed well beyond what would be the typical metrics of underlying economic uncertainty in the world. So this is why most of these areas on the right-hand side are sort of orange or reddish, and this compares not, it's quite a similar situation to the one we had in 2006, right before the beginning of the crisis. That doesn't mean that we're going to go in the same crisis. What it says is that it's interesting that there are some similarities there in terms of the underpricing of risk in fixed income markets and in terms of volatility being very low, below what might be still reasonable. How about emerging markets? Emerging markets are not the locus of these excesses, but emerging markets have other excesses, which I want to mention now. And these emerging market excesses are in the corporate debt sector. And if one looks at the evolution of corporate debt in emerging markets over the last few years, one can see that it has been increasing by about 10 percentage points of GDP, and it has come from domestic banks and also from the issuance of bonds, mostly in international markets. So there has been a re-leveraging of corporates in emerging markets. And in principle, there is nothing wrong against that, insofar as this money is put to good use in terms of investment that allows these economies to grow faster. But it so happened that there is also a disconnect between this amount of corporate debt that has been increasing and the real investment that these emerging markets have undertaken, which is only a small fraction of that. Another relevant dimension when we look at financial excesses, and I think this is a very important one, is to look at corporate debt in emerging markets from the viewpoint of what is the percentage of the corporate debt which is at risk, in the sense of belonging to firms which have a earnings over debt service ratio which is smaller than 2. These are the firms with weaker capacity to repay the debt. And as you can see, if we look at the blue bars and the red bars, over time, this debt at risk has been increasing. And nowadays, in the key emerging market regions, between 17 and 25% of the corporate debt is at risk, meaning that it is more fragile if you have changes in the economic environment that reduce growth so that the earnings come down, or a tightening of global financial conditions that increase the interest rates and therefore the debt service that they have to make, because that would lead to even larger increases in these bars. So between 17 and 25% of the corporate debt in emerging markets is at risk as defined by this metric. So this is the global scene. Let me now talk first about banks, and then I'll go to non-banks. So how about banks? And here we have good news and some challenges. And the good news is that advanced economies banks have become now considerably safer than they were a few years back. And one way of looking at this, there are other ways which are not so kind, but this one is the one that is normally used, which is to look at Tier 1 common capital ratio. And this was the situation in December 2008. And the red part of the bar reflects the percent of the bank assets in the sample which are below 8% capital ratio. So the more red you have, the worse is the situation. So there is a lot of red, very little blue, and very little green, which is where you have capital ratios between 12% or 10%. If one looks at the situation now, it's very different. The red is gone mostly, and you have much higher capital ratios in all of these advanced economies. So that's good news. If we had made a comparison in terms of the leverage ratio, you would still have a very significant increase, but not as pronounced as it is here, because risk weights also play an important role. So this is good news with the caveats that the credibility of the risk weights is something which is under examination by the international regulatory bodies, and particularly the Basel Committee. But the challenges are that banks face important issues regarding their business models. And if one looks at the evolution of profitability of banks across regions, and for that, what we did is to take the largest 300 banks in advanced economies, which comprise the bulk of the banking system, and ask the question, what's the evolution of the return on equity of these banks? And what one can see is that during the crisis, the profitability of banks really plummeted. Then there was a recovery in some parts of the world, but after a short recovery, it plummeted again in the euro area. So profitability is now significantly low and lower than the average of 2000, 2005. So why is profitability low? Well, there are various reasons. One is the cyclical situation. The cyclical conditions bring profitability down. I would say this is the case now in most of these areas in advanced economies, except clearly in the United States, perhaps also to a lesser extent as well in the UK. But in all other cases, there are, especially in the euro area, the cyclical situation is taking a big toll. Also, you have regulation, which was meant to move banking from high risk, high return to lower risk, lower return. And this is something which is the price of safety, and that I think is the right social price to pay in terms of safety, and that has contributed to reduce profitability not only now, but also going forward. And there are other structural factors which are weighing in the low profitability, particularly in Europe, having to do with the large stock of non-performing exposures, non-performing assets. But there is one further reason why profitability is lower than it should be, even taking into account the cyclical situation, which is that banks in a number of areas still have to complete the adaptation to the business models, to the new post-crisis market and economic realities. And that's a process which is ongoing. So all of these factors explain why profitability is low. In fact, if one looks nowadays at the comparison between the rate of return on equity of banks and the cost of equity, which is demanded by shareholders, what one can see is that about 80% of the bank assets are suffering from this profitability gap, meaning that the return on equity is below the cost of equity. Now, why do I care about that? Do I care per se that banks are more or less profitable? Well, from the public policy viewpoint, one cares about that because having decent levels of structural profitability, not what you had before the crisis, which was excessive because banks were taking excessive risks, but having more reasonable levels of profitability than now, it's important because that's the way that banks generate earnings, that's the way they generate capital, and by generating capital, they generate the space to provide more lending to the economy and re-risk their balance sheets with a given solvency level. So it is very important for the role of banks in supporting the economy, how profitable they are going forward on a structural basis. And a key question that I want to pose now is to what extent are banks strong enough to support the economic recovery through lending? And for that, in this sample of 300 banks, we have looked at two dimensions: the size of the present capital buffers that they have, and also their capacity to earn reasonable earnings over time. And the findings can be, I think, easily illustrated with this glass, which divides the banks in terms of their bank assets into three categories. And this is the total sample. So this is the 300 banks, 100%, and this is just a representation of what percent of the banking assets in the sample are in each category. So the banks which, at the global level, in advanced economies, have large capital buffers to begin with and do not need to make very significant changes to the business models in order to achieve reasonable levels of profitability. That is, the banks that are in a better position to support lending going forward. This is about 60% of the banks. These are the ones in the green part. While the rest of the banks have work to do, either in terms of significant transitions needed in their business models or even resolution and recapitalization. And this is something at the global level, but which differs across the different advanced economy areas. And as you can see, there is an important contrast that basically tells you how advanced are the banks in the process of adjusting the business models. And there you can see a significant difference between North America, for example, which is the United States and Canada, and the euro area. And if I had taken this picture 5 years ago, probably in the United States or North America, we would have been closer to where the situation is now in the euro area. I'm conjecturing, but that tells you that it is in the euro area where there is a need for larger adaptation of the business models of banks in order to allow them to get the sufficient earnings over time that would make them able to sustain lending. And that's an important job going forward, where the single supervisor needs to play a role in supporting and facilitating this process, which needs to be driven by the main players, which are the banks. But that's something which is key in order to have the lending which the economic recovery needs in Europe. So let me move now to the non-banks or shadow banks and basically make the point that credit intermediation and risks are shifting there to that part of the financial system. And this is good news from the viewpoint that the non-banks are playing an increasingly important role in providing finance to the economy. So to that extent, they can help very much the global recovery, not so much in Europe, where one still needs to develop the non-banks. But it's also true that the locus of risks is also shifting with activity to non-banks, to the shadow banks. And I just want to give some metrics. One is, if you look at the importance of investment banks in a country like the United States, you can see that if you compare the situation in 2003 and 2013, vis-a-vis other financial agents, what you can see is that investment funds are becoming very important now, almost as important as banks in terms of the financial assets. In terms of the ownership of bonds, corporate bonds, if one looks at investment funds and households, they nearly hold 30% of US corporate bonds. And that's important because investment funds and households may be more prone to redemption risks, to I want my money back type behavior than other more stable institutional investors. And finally, and this is just a positive assertion, global asset managers are very important. The top 10 asset managers basically handle 30% of the total assets under management in the world, which is about $20 billion. So it's very important that reputation and the appropriate controls are taken on the part of these global asset managers, because they're really important financial institutions. And I think that's key. The key issue in terms of the non-bank sector has to do with liquidity risk and market liquidity risk. And what we're seeing is that at the global level, there is a contrast between monetary liquidity, which is ample, for example, as represented by the increase in central bank balance sheets. I could have used many other indicators to show that global liquidity is ample. But we have a problem because there is a liquidity of illusion in credit markets, in fixed income markets. And that liquidity illusion is that investors think that the high liquidity that they see now in the markets in good times is going to be there forever. It's going to be liquidity for all seasons, while this liquidity is mainly fair weather liquidity, is liquidity for good times. And you can see, if one looks, for example, at the beta spreads, that the lower it goes, the more liquid is the market. That would be one indicator. I could have used others, but that's an indicator that at present liquidity is very high in markets. But one cannot take for granted that liquidity will be there when markets become under stress. Because if one looks, for example, at a simple indicator, which is the number of days that would take to liquidate US credit mutual funds to give money back to the investors, it would be over a month, which is very different from, the 2 to 3 days that you have now when investors want their money back and they get it. So if markets get under stress, the liquidity, the structural liquidity, the structural resilience is not there. And this is very important because there are a number of investors that may get caught into this market liquidity trap if shocks hit the system, and this may lead to very significant adjustments in prices, asset prices going forward, which may have important repercussions for agri demand. Now, why is this important? Well, it's important not only in advanced economies where these markets are most relevant, but also it's important for the whole world because of the deep interconnectedness financially between advanced economies and emerging markets. And that's something which is just the reflection of globalization, and that's something which is a great positive, but one also needs to be aware of the risks which are associated with that in order to try to bring them under control. For example, if we look at the rising share of emerging market assets in advanced economies portfolios, that's good because it means more diversification internationally, so that the share has gone from 6% to nearly 13%, and the volume of assets now from emerging markets in the hands of advanced economies portfolios has gone from 0.6 trillion to more than $4 trillion. And I think that's very good, but exemplifies the more interconnectedness there is. And if you look at this graph, which is sort of like a biology chart, where you have basically on the left the source countries in terms of the main financial centers which are originating these flows into emerging markets, and on the right-hand side, the destination countries. What you can see is that the sources are very concentrated in only a few financial centers, and the destination is also going mainly to the 12 largest emerging market economies. And there is a little bit now going into low-income countries at the bottom, but basically there is a lot of concentration both on the source side and on the destination side. And that tells you that if there is something happening in advanced economies markets because of this liquidity illusion and this market liquidity trap, this is something that would have global reverberations through asset prices internationally. And one practical question is, yes, there would be spillovers, but how large are they likely to be? And let me offer an example of how global and important these spillovers would be by looking at the times by which volatility would be amplified between a low risk aversion, low volatility regime like the one prevailing now and a high risk aversion, high volatility regime like the one we could have in the future. And this is just based on the statistical evidence of what's happened in the past. And the assets that you have there are ranked in terms of the riskiness. And here you have the safest assets, which are the sovereigns in the United States, in the European Union, and in Japan. And then you have higher risk assets as you move to the right of the picture. And the height of the bar tells you the number of times that the volatility, how many times will the volatility be higher in the future than now? For example, sovereign bonds in the United States, volatility would be about 3 times higher in the higher risk aversion, high volatility regime. But if you move to local sovereign bonds, local currency sovereign bonds in emerging markets, the volatility would be something like, 13 times higher. So we are, in principle, there could be a very significant decompression of volatility that needs to be taken into account. And the reason why this is important is because there could be potential domino-like effects of market and liquidity risks. Effects that may be triggered by shocks. The most important ones in my view are, geopolitical risk escalating to levels that we have not seen now, God forbid. Monetary policy normalization in the United States, which may be bumpier than markets now expect, or any other shocks. And the one I think is most important is the potential for a negative growth shock in the euro area, for really a stagnation in the euro area. All of these shocks will trigger effects through financial markets, which would be reflected into the reversal of flows. People will want their money back. This is something that will be exacerbated by the larger presence now of redemption-prone investors in the context of markets which would not be terribly liquid because of what I mentioned, This will lead to very significant price adjustments through fire sales or correlated selling, and this would have important consequences for asset prices both in advanced economies and emerging markets and developing economies because of the interlinkages I've just mentioned. So this is basically where we are. These are the main risks that we have highlighted in our Global Financial Stability Report and some of the policy recommendations that we put forward to address this global imbalance, which is below underneath all of this is a simple one to say, but a complex one to do. First, better support economic risk-taking so that there is more of it of the sort that you need for growth. And for that, it's particularly important to improve the flow of credit to the economy. That's key in Europe, facilitating banks' transition to new business models and developing safe sources of non-bank credit, of market-based finance. So more economic risk-taking in support of growth, also helped not only by these policies, but also by structural policies and by demand policies so that you cover both the supply, agri-demand and agri-supply spectrum. But to maintain financial stability under control and address excess in financial risk-taking, prudential policies need to play a key role. In some countries, they are playing it. In some countries, they are playing a lesser role. And it's important to strengthen them, and in particular, to focus them on the rising market liquidity risks in shadow banking so that one can prevent market runs, or start thinking of the what-if question, if we had some market runs, how to limit their costs, both in advanced economies and emerging markets, so that these problems do not become too difficult to handle. So this is something that calls for increased alertness on the part of supervisors, on the part of regulators, on the part of other authorities, central banks and treasuries, and the need for action now, so that what is at the origin of this issue, which is that monetary policy is the only game in town, that this problem is solved. Monetary policy needs to continue doing its job, but it needs to be much better supported by other policies so that fiscal policies, structural policies, and financial policies address this global imbalance which has emerged and which may have negative consequences for financial stability and the recovery at the global level. So let me stop here. Sure.
Thank you very much, Jose. That was terrific. And your graphics department, minoring in biology, was also terrific. There's obviously a lot of weight carried in your words, and I'm sure similar words were spoken a few weeks ago to the official sector. But one of the key developments in the last few weeks has been the release of the AQR and all the work that the European Central Bank has done. The glass is full of banks that have insufficiently strong assets to support the recovery are quite terrifying. So how should we look at what's happened recently in Europe? Does that mean we've seen the worst of it? Are they on a path to improve those assets, or are there more specific things that the European supervisor should be doing from this point forward?
I think that the first thing to say is to acknowledge the progress that Europe has made, and I think that it would be unjustified not to acknowledge that. And the last part of the progress has been this comprehensive assessment, which is the beginning of the banking union. And I think that this is a really important opportunity to basically get the banking system to the stage where it should be. And I think that this is a major task ahead of the European Central Bank. I think that the comprehensive assessment has been the beginning of a process rather than the end of a process. I think one cannot say, okay, that's it, let's forget about it. No, this is basically understanding what the situation is, understanding the reality of the banking system in Europe. A good consequence of this comprehensive assessment is that because banks were fearful of the reputational impact that this could have, they have anticipated significantly the raising of capital, and I think that this has been a good outcome from the exercise. So overall, I think that this exercise has been much tougher, much more rigorous, and much more credible than the exercises that were performed in the past. So I think that these are all positives. But I would signal two things that are the important work for the authorities going forward. One is that the comprehensive assessment has led to an annual revision of nearly 18%, 1/8, of the non-performing exposures of European banks, which now reach nearly 900 billion euros. And that is something that needs to be managed. And the management of that is not going to fall in at the center, but is going to fall for a number of years because of capacity reason with the national authorities. Mm-hmm. So this is a very important challenge that needs to be addressed, which is the management of these non-performing loans in order to clean up the balance sheets. By the way, these nearly 900 billion euros of non-performing exposures, all of this 900 is trapping part of the balance sheet which is not profitable. So you need to clean that up in order for the banks to free that part of the balance sheet and become more profitable. But it's also clear to me that European banks need to walk the walk that other banks have walked in the United States, in other parts of Europe outside of the euro area, like in the UK, like in Sweden, like in Switzerland, of further reinforcing their situation and going to more structurally profitable business models. One issue there is the extent to which there is overbanking in the euro area, and I think that there are grounds to believe that there are small countries with 700 banks, other not so small countries with more than 1,000 banks. So this is something that needs to, presumably over time there will be a process of some consolidation in the industry. This is a process that needs to be driven by the private sector, but I think that it would be important for the new framework to facilitate this process. Now there is going to be a single supervisor, which means that some of the national biases and obstacles to cross-border mergers on political grounds would be much lower now than in the past, and I think that's good news. And also the fact that in Europe there is now this single resolution mechanism with a single resolution fund and directives for bank recovery and resolution will make the resolution of banks and the exit of banks more easy than it used to be the case until now. And if there are too many players, some of these banks which are weaker, exiting the playground would leave more space to others which can benefit from that. So I think that there are a number of things that it is my intuition will happen in the future, and I think that the framework is now more conducive to these changes happening. But again, this needs to be a process driven by the industry, and I think that the banks need to think also in banking union terms. Now we have an official banking union. Now we have to have the banks also adapting the business models and the strategies to something which is not just national, but also more European. And interestingly enough, banks are national and global outside of the European Union, but not so much European as, in my view, I think could be in the future. So I think that this is something which is another task for the banks and for the supervisor to support, the single supervisor to support this process, not to prevent it, but support it.
No, and clearly, as you put it, structural unprofitability has been the recurring theme of banking crises throughout the decades. A second question, I mean, you had three pillars to your talk, and going to the third pillar, you used the term shadow banking, and we were joking at the table at lunch, or not so much joking, wryly remarking that that's a very charged term. Leaving the syntax aside, part of what I think a number of us are concerned about, including people like me who are generally favorable for strict regulation, is some sense that the FSB is cramming bank-style regulation on a lot of entities that may be systemic or may be important, but are not banks. Now, you didn't get into the specifics of it here. You talked about wanting the liquidity potential issue in the asset managers in the U.S. But, I mean, how do you see the regulatory agenda going forward, or the supervisory agenda going forward for insurance, for asset managers? Is the FSB just saying everybody needs lots of capital and we'll be okay, or is there more to it than that?
I think that one very important message that we are trying to convey through the work that we're doing at the IMF is that, and I think that this is recognized also by the way the FSB is working, is that one doesn't have to look or doesn't have to regulate based on entities, but on activities. And I think that philosophy needs to be more and more embedded. It is, but it needs to be more embedded. In terms of the work that is been done on regulating shadow banking, or the risks coming from non-banks, one thing that is already advanced is for banks to better take into account the exposures to the shadow banks through appropriate capital weights, and this is something which is advanced. The Financial Stability Board now is in the process of has designated systemically important insurers. These are entities that would be subject to higher capital loss absorption requirements, let's say, in the future. There is now a process of saying if there are risks in non-bank, non-insurance entities, but I think we need to go beyond entities into activities. And from that viewpoint, the regulations that are in the pipeline regarding margins, avoiding procyclicality of margins in security lending transactions, in repo transactions and all of this is quite important. And I think that the idea would be that all of this is developed, and in the next couple of years, this would be in place. And I think that we need to strike a balance between trying to keep systemic risks under control on the one hand, and not limiting activities which can be very fruitful for the financing of the economy. And this is always a very difficult balance. And just to make a point regarding the overall regulation, I think that a lot of regulation has been put in place on the banking side, on the non-banking side, and we need to monitor the impact of this regulation on the economy to see if there are intended consequences, and if that's the case, to draw the proper consequences. So I think that's a process that needs to happen on a regular basis.
Well, you've taken me exactly where I wanted to ask my last question before we open it up to our audience, which is bringing this all back to your first point, where you very graphically and tellingly talk about the gap between perhaps too much financial risk and what certainly seems like too little economic risk taking, too little economic investment. Now, at the same time that you and your colleagues have been working on making the system safer, we've been hearing from a bunch of people about the need for infrastructure investment globally, the need for long-term investment. I mean, leaving aside the corporate underinvestment, which has many causes. We had Bertrand Badre here a couple months ago talking about the World Bank's initiatives in this area. How does one, picking up on what you just said about the evaluating the nature of systemic protection versus giving credit to the economy, do you see a tension between where things are now and the availability of long-term financing for infrastructure, private financing for infrastructure, or do you think we're at a good space?
I think that this is actually an area where we are doing work, and we're looking at it very carefully, because it's regulation having to do with banks, it's regulation having to do with insurance companies, it's Solvency II in Europe as well. And I think that at a time where the public sector is burdened and has a lower capacity to engage on public capital formation, it is very important that the private sector really takes the lead. And we are looking into this question to assess the extent to which some of the things that may have been put in place to make the system safer may not have had unintended consequences. So this is work in progress, but there are some signs that there may be some limiting factors. And again, this is an issue that we will need to take very much into consideration as we continue to do work on the calibration, on the net stable funding ratio and so on, which limits the maturity transformation process of banks.
Right.
But I think also in terms of initiatives like Solvency II and so on, that's very important. And I think there are two important things here, that the world may need long-term financing in terms of debt, but the world also needs a lot more equity. Mm-hmm. And maybe we need more equity than debt. And if I can go back to the European example, people are saying market-based finance, market finance, yes, but not just focus on debt, focus on equity. And I think that this is what's been done, is the right approach. And that leads me to the structural reforms. If you are trying to stimulate bond finance, I think that the bar may be lower than if you're trying to stimulate equity finance. Mm-hmm. Because with bond finance, if you're a creditor, you just want your interest and the principal to be paid. But if you are an investor, you have a higher rate of return expectations if you're an equity holder. And that leads me to the key role of structural reforms, mm-hmm. of enhancing the rate of return, profitability of corporates, so that they can yield a higher rate of return. And that's something that will help develop more equity financing in the future. So let's think of equity as compared to that as well, and not just on market-based finance. I think that equity is very important, and there is too little of it, particularly in Europe, maybe in the world, but particularly in the case of Europe.
Thank you very much. That's very clear. As usual, we're going to go to on-the-record questions from our audience. People in front, raise your hand, and I'll recognize you, and just go bring you a mic. People, if you could go to the back mic. Yeah. And if you'll identify yourself when asking a question. First, Ian at the back mic, and then Phil there at this table.
Jose, always interesting.
Identify yourself.
Sorry,
please.
Ian Talley, Wall Street Journal. The IMF estimates that Europe could go into a recession. I think it puts the risk at 38%. And you were saying that is one of the most fearful growth shocks that could precipitate this type of financial crisis that you're talking about. So am I to assume that there is a more than 1 in 3 chance that the global financial system is shocked again because of the growth shock there? Secondly, if what I hear you saying is you're outlining some very clear risks ahead, but that's not really the message that I heard out of the IMF G20 meetings last couple of weeks. I'm wondering why leadership is not waving the red flag. And then finally...
you only get 2, Ian.
This is an excellent question, though.
Sorry, next time.
I'll come back.
Okay. On your first question, I think that the translation that you have made is a little bit linear in the following sense. It is true that for the euro area, we foresee a risk of relapsing into recession, which is slightly higher than 30%. But this is not a central scenario. This is a risk. The central scenario is a continuing recovery, weaker than we were anticipating 6 months ago, but a continuing recovery, which would be leading to growth which is slightly stronger, above 1% next year, as compared to growth which is slightly below 1% this year. So that's a central scenario. It is true that there is above 30% risk that there could be a recession. Now, are we also saying that given that this is one of the risks that I have outlined, this is something that is going to lead to a 30% chance of a global financial crisis? No, because the slide that I show where there are these nominal-like effects, that doesn't necessarily mean that this is going to lead to a crisis. This is going to lead to important downward adjustments in asset prices. And this is something which may just have macroeconomic effects. This is something that will lower wealth. It is something which will lower, and thus consumption, it will lower investment, it will lower agri demand, and therefore it would hurt the economic recovery. It's only in those instances where the adjustment in asset prices is so deep as to touch a key link in the financial system chain, that you would add a systemic dimension to that. And I cannot tell you the probability of that happening, among other things, because the information gaps that exist about the non-bank or shadow banking sector are very large, and it is very difficult to understand these things with precision. So having said that, this issue of the euro area risk going into recession is something that worries the Europeans a lot, that worries us a lot, because the euro area is a very important player in the global economy, and because confidence effects. But we are not saying that this is something that is equivalent to, if that risk materializes, to a 30% risk of a global financial crisis. We are not saying that at all.
And so therefore no red flag waving. Okay. Phil there.
Hey there, Phil Suttle from Tudor. I have two questions. One's very specific and one's more general. The specific, in one of your charts, you had a fantastic graphic about the days to liquidate portfolios, a higher yield portfolio. But I was unsure how you define that, where you got those numbers from. So if you can answer it, great. If not, I'd be interested in some follow-up, because it's a very important topic. And but I was just a bit unclear where those numbers came from. My more general question would be, a lot of the risks and issues and challenges that you put up there, which, by the way, I completely agree with, would seem to me to be, at least in part, maybe I would say actually largely, the result of policy decisions made. So the constraints on bank lending and the deleveraging of the banking sector are primarily a reflection of the regulatory environment we now live in, and the incredible frothiness in non-bank credit is primarily a reflection of QE strategies being adopted by central banks. In the light of the last point, I'd be interested in how your concerns may have changed in recent days and weeks, given that since you did all this work, the BOJ has upped the ante considerably with extra QQE. And although we're still a bit unsure what Mr. Draghi and the ECB's up to, it does look like today the ECB promised another €1 trillion of balance sheet expansion. So do your concerns about frothiness go up because of these strategies, or is this just more of the same?
Mm-hmm. On your concrete question first, and then I address the other. The indicators that I showed in terms of the number of days that would take to liquidate the assets under credit mutual funds in the United States is derived in a very simple way. Look at the total assets, look at the daily turnover, and then you say, well, if everybody wanted their money back, how many days would I take? So it's a very simple metric, and it's just an illustrative example. So that's all there is, but that's how it's calculated. On your more general question, what happened in Japan, the ECB, and so on, I'm not one realizing that there is risk-taking. There are pockets of excessive risk-taking, which I have described. I think that deriving from that monetary policies have to tighten now, I would not be comfortable with that. I don't think that's the right message. I think that if monetary policies in Japan, for example, or even in the euro area were to tighten now, what you would have would be an implosion of economic activity, and there is nothing worse for financial stability like deflation. So I don't think that would be the right course of action. It would be the wrong course of action. The right course of action would be to say, hey, monetary policy is trying to do everything, and that can no longer be the case. So you need the help of other policies. And in the euro area, if you really want to stimulate investment more, you need the structural reforms that increase the rate of return on investment. And in countries which have fiscal space or which have the space to, and basic, some infrastructure needs and big current account surpluses, well, that's something that could also be helpful to have some investments in infrastructure. So I think these are things that could be very helpful there. And in Japan, you have to make the third arrow happen, which is a very important thing. So I wouldn't drive the conclusion that one needs to tighten monetary policies. I would say no, you need to accompany monetary policies by other policies which are not doing their job now. But I would also highlight the role of prudential policies, both micro and macro-prudential policies in keeping financial stability risks under control. In the case of the potential for market runs, this is something that would call for intensified oversight of mutual funds, for example, and for stress testing on the part of supervisors' liquidity in mutual funds to see what would happen and what measures need to be taken. It may call also for other things, but that's the type of macroprudential policies that should be now in place rather than undo monetary policy, which would be lethal at this stage. Only countries like the United States and maybe Britain soon can afford to normalize their monetary policies. The others, unfortunately, are in a very different place.
And of course, when you normalize, nothing's going to happen. The gentleman at the back, and then the gentleman over here.
Hi, Andrew Maeda from Bloomberg News. Just wondering if I could get your thoughts on Mario Draghi's statements today. He said that he would boost stimulus if necessary in the Eurozone. At the same time, there's been criticism that he's not moving aggressively enough in terms of both the size and the scope of his asset purchases. What's your view on the Eurozone at this point?
If monetary policy is complicated, monetary policy in the euro area is even more complex because you face very different national economic realities, which at the end of the day aggregate to the euro area. In the European Central Bank, as Mario Draghi has signaled repeatedly, is concerned about their mandate, which is to guarantee or to come back to price stability, and that is something which is becoming difficult now, and this is why the ECB has done all these things that they have done. I welcome very much. By the way, we at the fund strongly support the actions that the ECB has taken up to now in order to fight deflation risk and to bring inflation in line with the mandate of the ECB, which is close to but below 2%. So we are very strongly supporting those actions. And we welcome the statements that the president of the ECB has made today, but also in the recent weeks, to say that if the situation were to require it, they would use the tools which fall within their mandate in order to do what is required. And I think that this is something which is very important from the viewpoint of instilling confidence in markets. Now, regarding the program which is now in place, I think, in terms of the TLTRO and in terms of the purchases of asset-backed securities and covered bonds, what I would say is that, especially the latter, just started. I think that we need to give it time, a few months, to see what happens. And in terms of the TLTRO, some market commentators were disappointed that there was not a larger take-up by banks in the first occasion. Well, there's a second one, which is now in September. And I think it's logical for banks to wait until the end of the asset quality review and the stress tests in order to see how much more are they likely to need. And I think that one has to wait until December to see what the take-up is. But let's give time to theyese measures. I think they're important. How much difference do they make at the end? We'll see. And then on the basis of this and the outlook for inflation and for growth, I think that the ECB will have to draw its consequences. But I think it's a good signal that they're ready to go further if necessary. I think it's a good signal. And I think that today, when markets were looking at the statement, all of this was, I think, positive from the viewpoint of strengthening market confidence.
It'd be better if they recognized it was already necessary, but that's okay. The gentleman here.
Thank you. Neil Rowland, MLEX News. In which geographical jurisdictions do you see the most significant shadow banking risks?
Well, I can respond to that quite quickly. Basically, in the countries where non-banks have gained more importance, and you have one economy, which is the United States, where the shadow banking sector, as defined by, let's say, the FSB and their reports and so on, or as we define it, is the largest, but also China. These would be the two economies where this subject is worthy of particular attention, with different forms and natures, but worthy of particular attention. And we have looked in our work at what are the key drivers of shadow banking, and we come up with 3 drivers. One has to do with easy monetary policies. Another has to do with regulation on the banking system, which shifts the risks to outside of the banking system. And the third is the development of institutional investors. And these are the 3 common drivers of what is called shadow banking throughout the world, advanced economies and emerging markets, regardless of the very different nature that these activities take in different countries. So these are the drivers, and where the process is most advanced is in the United States and China. In terms of growth rates, what you can see is that there are a number of emerging markets where the process is growing rapidly. And you have economies like Argentina or India, where this process is growing very fast from year to year, although starting from a very small basis.
Can I?
Well, China, because you have a lot of trust funds, a lot of wealth products that have been instituted to provide credit outside of regular banking system channels. And this shadow banking component of total credit, it's nearly 40%. So this is a very significant fraction of the total credit provided to the economy. And in part is a response to regulation, because the banks have set up in many cases these vehicles to provide credit in those cases where there were regulatory limits to the type of activities that they could carry out. And for example, lifting the cap on deposit rates would help intermediate some of these activities into the banking system. Better prudential regulation of these other activities, I think, would be very good. And the reform in the interbank market, which is happening in China, in order to make it less of a source of financing for the shadow banking and more of a source of financing for what it needs to be, is also a good policy initiative on the part of the authorities. But the shadow banking in China is really is the largest in any emerging market at present.
I'm going to go to Morris and the lady in back in a moment, but can I just follow up on that? I mean, one way of hearing you and also some people from the Federal Reserve and other places talk is there seems to be, I don't want to say it's an assumption, but it sometimes comes across as though we've got a toothpaste tube, right? So we squeeze on the banks and the tube bulges out someplace else. But even if the risks of the particular investments don't change, isn't it possible that the transmission of shocks is different in different parts of the system? I mean, there is long literature suggesting that we have problems with banking systems because you have deposit insurance, for example. Or as you said earlier, speaking from a different perspective, you're very concerned about the relative profusion of debt versus equity. And if we're moving to a system, you can call it shadow banking, but where a greater proportion of investments are financed with securities like instruments or non-debt instruments, maybe that's better. I'm not trying to hold a particular brief for any industry here. I'm just sort of struck by sometimes the shadow banking discussion seems to suggest that, well, it makes no difference where the stuff goes. It's always bad.
Well, I think that is not always bad.
Okay.
And the good thing is that it's most often good. And I think that's a good part of it. And if we forget the semantics aside, I think that not only the academic literature, but also the international experience shows that countries which have more developed financial systems in terms of better developed banking systems, better developed market sources of financing are countries which are in a better situation to finance growth on a sustained basis, and also which in principle have more resilience. Alan Greenspan used to say that market-based financing is like a spare tire.
Right.
And I think that's right. So I think that this is important. On the other hand, one needs to be very aware that together with these larger importance of banks and of non-banks come risks that need to be taken care of. And this is like patients which need to take a medicine or to grow, but there are side effects. You want to provide a medicine, but you want to take care of the side effects, but you don't want to discontinue the medicine.
Right.
I think that what the crisis has shown is that there were a number of financial excesses that should not happen again, and this is why we have regulation now going on the offensive in order to avoid that these financial excesses happen again. But I think it's a question of balance, and I think that it's mostly good, but there are some bad things that could happen, and I think that the role of the regulators, both the micro and the macroprudential regulators, is to spot these soft spots regarding the systemic risk and then try to take preventive measures so that these risks do not materialize. And I think that this is how you can understand all the development in terms of macroprudential policies that is been taking place now, both at the global level and in particular in some countries like the UK and even the US and so on. So that's my take on that. So
No, thank you. That's
rather positive.
no.
But I agree with you on one thing.
Right.
The transmission mechanism of shocks is very complicated outside of the channels that we have studied the most.
Right.
And we have studied the most the traditional banking channels. This is why this is an additional challenge to the design of macroprudential policies, information gaps,
Right.
and also lack of knowledge about the transmission mechanism of shocks and of policies.
No, and to be clear, I give you and your colleagues in the department a lot of credit. Like Phil, I mean, I thought the slide where you're trying to do the exercise of what a sell-off would mean in the mutual fund market, for example, is the kind of constructive engagement we really need, for what it's worth. Could I ask Morris and then the lady at the back, Mike, to pose their questions, and then Jose can get the last word.
Hi, I'm Morris Goldstein from Peterson. I had two questions for Jose. Before getting to those, let me just thank him for what was, I think, a comprehensive and very interesting talk. The GFSR is always interesting, so it's nice. Two questions. One had to do with bank safety, and the other one with the shadow banks. When you were showing your chart on capital ratios going up, you did mention that if you had focused instead on leverage ratios, it would be less. Well, I've been looking at those numbers, and my impression would be a lot less, particularly if we looked at European banks. If you go back to the mid-'90s, they had leverage ratios about 6%. If you go, then right up to the crisis, they got down to 3, 2, and come up a little since then. Tom Honig from the FDIC tracks those, puts them on the same accounting standards. And anyway, my impression is in Europe, if you look at leverage ratios, the improvement has been glacial. There is some, but it is really, I'm not making a technical point. I'm just saying if we look at really what's happened with bank safety, and if we looked at a different indicator, it would be substantially less. There would be some improvement, but anyway, you might react to that. Second, on shadow banks, I wanted to ask you to elaborate a little bit on where that growth comes from. I was at a conference a day or two ago, and one of the interesting things that came out of that, someone was saying, well, we used to think of the growth of shadow banks as an arbitrage thing, getting around the regulation that was in banks, SIVs, all that stuff. Now a lot of that's over, and the growth is being driven by other things, including things that, to me, weren't obvious at first thought, like reserve accumulation. So it turns out actually that currency manipulation also drives shadow banking. But there's corporates, there's other things that are less arbitrage based. So I wonder if you'd talk a little bit about whether you agree with that view or not.
Can't have a Peterson event without currency manipulation. Yeah. And the lady at the back.
It's for two quick questions. You talked about
You could
China's-
identify yourself, please.
Leah from Voice of America. You talk about China's shadow banking problem. I'm just wondering if the IMF has come up with a specific figure about the size of the shadow banking. And also wondering if you can talk a little bit about the debt problems in the Chinese banks. Thank you.
About the debt problems? of
In the
China-
Chinese banks.
Okay. Let me address these last questions from the lady first, and then I go back to Maurice. It is difficult to estimate the size of the non-bank sector in China. Our estimate is something close to 30 to 35% of GDP. Okay, so that's the answer to the first question that you had. Second question is the situation of banks. Banks have in China nowadays very low non-performing loan rates, but banks are very much exposed. I mean, they have a lot of real estate assets. So there is and many corporates are also very much heavily into property market and so on. So that's an issue that needs to be monitored carefully, because if the property market were to collapse in China, there would be quite a number of corporates that would be in trouble. And I'm talking about a significant fraction of corporates that would be in trouble. And some of them will take a toll on the banks. Of course, we know at the end of the day that in banks in China, at the end, is not so much a financial stability problem, but it is a fiscal issue, because the authorities have sufficient resources to deal with the problem. But it would nevertheless be a negative shock that could have negative implications for growth. And that's something that would be bad for China and for other economies which depend on the speed of Chinese growth, which already has moderated in the recent past. Back now to the issue of bank leverage in Europe and to the issues of shadow banking that Maurice was posing. I know the data that Tom Hennig is using, and in fact we were talking about it last week in Berlin, where we both were at the conference talking about these things. And I think that even on a leverage, with a leverage ratio, if you look at where European banks were 5 years ago and where they're now, the progress has been dramatic. And we have gone bank by bank to look into that. We have gone bank by bank, both in terms of Europe and other advanced economies and emerging market economies. And the leverage ratio is fine, in the sense that it's above the 3%, which is international standard. The question that you may raise is 3% as a standard too low, or should the standard be higher? And I think that's a genuine discussion. In the United States, there is a supplementary leverage ratio. There are other countries which are thinking of having higher leverage ratios. But I think that the numbers with the current leverage ratios also reflect the important improvement. One question which I think is behind or one issue which is behind your question that I think is very important is that there are some serious doubts about the credibility of the risk weights that banks apply to value their assets and to attach risk weight to the assets, and which may mean that some of the risk-weighted capital ratios are too looked to be true. And this is something which is a concern also on the part of regulators. The Basel Committee is looking into that. And banks which have very complex securities and which use models to value these securities or and who use internal based models to produce these risk weights, there is a lot of cooking there. And the suspicion is that in many cases, these risk weights which come from these internal models are not consistent with the underlying riskiness of these assets. And this is why it is very, very fundamental that the credibility of risk-weighted assets is restored, because otherwise there will be always someone like you who genuinely asks the question, why should I care about risk-weighted assets if they are meaningless? And I think that's something which would be very negative to the credibility of the whole Basel process, which has the risk-weighted assets as the main ratio and the leverage ratio as a backstop. Now, you could say, why don't we have the leverage ratio as the main ratio and forget about the risk-weighted assets? Because you have the same problem as type 1, type 2 errors. That if we go to the non-risk-weighted assets to the leverage ratio, we go back to the wall of Basel 1, which basically says, I will go for the assets which produce the highest rate of return because the capital consumption is going to be the same. So that's the traditional line of defense. So I would think that the best state of affairs is to have risk-weighted assets, but with risk weights which are credible and that are not subject to the degree of manipulation. And then a number of initiatives that can be put in place and will be put in place, I hope, to make that happen.
Wow. Jose, as always, your command of the technical as well as the strategic is overwhelming, and it's great to have you share with us the combination of analysis and frontline work that you and your department are doing at the fund. Very glad to have you with us today. Thank you for sharing
Thank
your
you.
views.
Thank you for your words. Thank you.